On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope everyone is well. Today I want to talk about the NZX 50 index, the key share market index that we have here in New Zealand, because there was some news last month that hit the headlines about the NZX 50 hitting a fresh record high and finally surpassing the previous peak that came way back in January 2021. That was a long time coming. Other share markets around the world have all recovered from that post-COVID hangover much more quickly. But for us here in NZ, our market has taken almost 5 years to get back to that previous peak. And at first glance, this would suggest that it's recovered all of its lost ground, surpassed that previous high, and pushed on to bigger and better things. However, there is a catch, and let me share that with you. Because the NZX 50, our index, is different to many of the other benchmark share market indices that you see around the world in one really important way. It is what they call a gross index, and what that means is that it includes dividend payments as well as taking into account changes in share prices. So all of those other indices you hear about around the world, whether it's the S&P 500 in the US, the ASX 200 across the Tasman in Australia, and the FTSE 100 in the UK. They are all capital indices, and that means that they reflect only changes in share prices. They ignore dividends. They don't include those dividend payments. Now, when we exclude dividends paid and look at share prices alone here in New Zealand, our market is still 13.1% below that peak from early 2021. So we're still some way off being at a record high. That's the bad news. There is some logic to the way that our index is calculated, and it's not a matter of the NZX trying to fudge the numbers or do anything cynical, so no need to panic. The New Zealand share market has always been a high dividend paying market compared to others around the world, where dividends are a lot lower. And because of that, you sort of need to include dividends, or you aren't giving a true portrayal of what share investors here in New Zealand have received and the returns that they've got. When we look back over the past 30 years, more than 60% of the return from New Zealand shares has come from dividends. Now, in contrast, US share investors, they get a much greater proportion of their return from rising share prices, and dividends are a much smaller component of that return profile in the United States and in other markets too. Now, being a high income or a high dividend market, that's not a bad thing at all. In part, it reflects the type of companies that dominate our market. We have a lot of stable, mature businesses like those in the utilities sector. That's all the electricity companies, infrastructure, the likes of Auckland Airport or Infratil or Chorus, lots of real estate companies as well, Property for Industry, Goodman Property Trust, Kiwi Property, all of those ones. And these are all great businesses to invest in, but they're not high growth businesses compared to what you'd see in the likes of the US with the tech sector and so forth. So we are a bit more of a safe and steady cash cow market rather than a really high growth market. Another important reason for this dynamic is our relatively unique tax system that we have here in New Zealand, and in particular our imputation regime. Now, in short, when New Zealand companies pay tax on their profits, they accrue imputation tax credits, and they can attach those tax credits to the dividends that they pay to their shareholders, and that means that investors don't have to pay tax a second time because the company's already paid tax on those earnings. So when it is distributed and when you get those dividend payments, they're close to tax-free. Not completely tax-free because the company tax rate is 28%, and in New Zealand the top personal tax rate is 39%, and then there's one at 30%, and so on and so on. So it all depends how your investments are structured, whether you're buying those shares directly or via a PI, a portfolio investment entity. If you're doing that, then you essentially will get them tax-free because the PI tax rate is capped at a maximum of 28%, or if you hold them individually, well, it all depends what your personal rate is. So I don't want to delve into the tax sort of situation because we'll be here all day, but long story short, it is much more tax efficient for New Zealand companies to distribute their capital via dividends than is the case elsewhere. Australia is one of the only other countries that has a similar system. They call it a franking system. So we call those tax credits imputation credits. In Australia, they call them franking credits. Basically the same thing. And imputation credits here in New Zealand are only available to New Zealand investors, New Zealand shareholders. So if an international person buys a share in Meridian Energy or Spark or whatever, they won't be able to use those credits. Only we can as Kiwi investors. And it's the same for Aussies. So if you're an Australian investor, you buy shares in ANZ Bank or Westpac or whoever, you'll get those imputation credits. But us here in New Zealand, we can't buy those Australian shares and get those franking credits. So it's something that is unique to those two markets, and only their domestic shareholders can benefit from them. Now that is why you will often see US companies doing share buybacks to distribute capital, because it's far more tax efficient for them. And dividends, if they pay people dividends, those shareholders would have to pay tax on the dividends, whereas a share buyback means that there's no tax to pay. So it's a lot more efficient. So that is why companies in different countries and share markets will approach things differently. But for us, it means we're a high dividend market. Now, returns are returns, and I don't think we should be too concerned about whether we get them via income and dividends or capital growth. Returns are returns. But it does mean that we need to be wary of comparisons with some of these overseas indices. You can't look at the S&P 500, compare it to the NZX 50 without sort of taking dividends off one or adding dividends back to the other. So when I make performance comparisons between different markets over long periods of time, I will always add dividends back in to indices like the S&P 500 or the FTSE 100 or the ASX 200 to make sure that they are apples with apples with the NZX 50, and because I want to reflect returns accurately. And you get returns via capital and via income, so you need to incorporate both of those ways of getting a return. Now, in practical terms, many investors will have recovered the losses of recent years in New Zealand shares, but only because of that income that they've collected along the way. I think the final point, and this is a really important one, we can also take some comfort that as share prices here in New Zealand are still some way below that 2021 peak, the market is far from overheated, despite appearing to be at a record high at first glance. And that's in stark contrast to other markets in Japan and Australia, in the UK and Australia, certainly in the US. All of those major markets have hit new highs in 2025, but we haven't. We are still more than 10% below where we got to almost 5 years ago in early 2021. So if you look ahead and you think about the economic recovery that we're all hoping for, starting to see a few green shoots now, so that's positive. That should mean earnings growth is a little bit stronger here in NZ for most of our corporates next year and into the following year. And with share prices still trading at relatively modest levels compared to where they have been in recent years, we still have underperformed. Hopefully, that puts us in a solid position to perform well for investors over the next year or three. Okay, that's all for today, team. Thanks for listening. Enjoy your week.
For more insights, visit craigsip.com.